Business Now today, this 4th day of April 2022. Now, on the show, we've had a series of discussions about investing and what are some of the options that are available to you. Remember, we have discussed the issue of buying stocks. We've discussed various other issues. Today on the show, we're talking about one source of investment and saving known as government bonds. Essentially, you lending to the government, much in the way China, the IMF, World Bank, and many others do. So how does that work? And is it open? Who's eligible? How much do you need? All of these questions will be answered right here on the program. Let's get the show started. All right, so let's get the show started and on the road. We're talking about investing in government bonds. That's part of our ongoing series, just giving you information on everything you need to know how to make money or how to make chums in this economy, as it were. Kevin Gige, who's an equities trader at Genghis Capital, joins me. Kevin, it's always good to have you on the show. How are you doing?
I'm fine, thank you. Thanks for having me.
Good, great. Yes. So let's talk about government bonds. What are they and in what way do they differ, say, from buying stocks and shares at the Securities Exchange or from treasury bills for that matter?
All right, so government bonds are essentially what we call an IOU. So it's an agreement between you and I, between myself and our company, myself and the government. Now, for this purpose, we're talking about government bonds. So it's an IOU between I and the government. So the government needs some money for whatever expenditure they need to use it for. I have the money. I lend them the money, of course, at a prescribed interest rate. After a certain period of time, which we call at maturity, they give me back my money. And of course, during this tenure, I'll be getting some periodical interest income, which we call the coupons. Mm-hmm. So essentially, that's how a government bond works.
And how typically how long is the term for it? Because this is a long haul game, right?
Yep.
Yeah. So how long are they typically?
So first, we have two kinds of investments with the government. We have what we call the treasury bills, which are more or less like a bond, but less than 1 year.
Okay. So
under that, we have three of them. So we have a 3 months treasury bill or T-bill. We have a 6 months T-bill, and we have a 1 year T-bill. Anything above 1 year is considered a bond. So we have the benchmark bonds, which is 2 years, 5 years, 10 years, 15, 20, and 25. But in between, we have 3 year papers, 7 year papers, 11 year papers. So the duration can be, it's up to you to choose. So if the government is issuing an 11-year paper this month and you don't have an 11-year paper, you just wait it out.
Okay.
Until you get
the one for the duration that you deserve.
Correct.
You desire. So let's before we get any further, just break down some of the definitions that surround government bonds. So first, there's a coupon rate, there's a paper. So for many people who are saying, okay, what are some of the key terms we need to just know, before we go too far with the conversation?
All right. So I'll start with the simplest and the most exciting one, which is the coupon.
Yeah.
Coupon is essentially the interest rate the government will pay you for using your money. So you lend the government 100,000 shillings, they tell you we'll pay 10%. So that's usually the coupon. And it's paid semi-annually, which means twice a year. So essentially it's usually paid around June and December. Mm-hmm. So if it's 10% of 100,000 shillings, then you end up getting 10,000 shillings a year, which is paid 5,000 shillings in June, 5,000 shillings in December. Mm-hmm. And so on and so forth until the maturity of that paper. Coming to the paper, so you'll hear most people talking about the paper. Paper is essentially just the bond.
Okay.
Yeah, so the government is issuing a 5-year bond. We call it a 5-year paper.
Okay.
And that's a term that is used primarily on the secondary market. Again, the secondary market is where you've already purchased your bond from the primary issuer, which is the government. That's the CBK. Yeah. Once you purchase, say, a 5-year paper and say within 3 years you need your money back for whatever reason, you can come to a market intermediary, for example, Genghis Capital, and you can say, okay, I bought a 5-year paper, but for whatever reason, I think I need my money now after 2-3 years. Okay. So you'll come to us and we'll then sell that paper for you. That is the secondary market.
I see.
Correct.
Okay. So now we are very clear on all of that, and we started to get into a little bit of how it works. Yep. So let's begin with, who's eligible. Can anybody buy a government bond?
Essentially, everyone can buy a government bond, except, of course, guys who are money laundering, if you're behind bars and all that. But if you're a law-abiding citizen, then yes, you can buy a government bond.
How much do you need?
The minimum you'll need is 100K or 100,000 Kenya shillings, and incremental of 50,000 shillings going forward. So you can buy a bond for 103,000 on the primary market.
Okay.
Yeah, on the secondary market, you can buy 101,000 if you want.
Okay.
Yeah.
So you have your 100,000 to begin with. So what are the steps that you need to do, first of all, that make you, eligible towards buying that? So when you go to, government and say, I want to participate in bonds, what are some of the requirements that they will ask?
So the first thing you'll need is you need to open an account with the central bank. So central bank here is the agency, is the agency that acts on behalf of National Treasury, which is the government of Kenya. So the government will need money for, say, the Nairobi Expressway or SGR or wherever. They'll talk to the Treasury Ministry. The Treasury Ministry will come up with, okay, we need 10 billion Kenya shillings. They'll now talk to CBK to see which is the best way and the cheapest way for the government to raise this money. CBK will tell them, okay, it's a 7-year paper and you're going to give a rate of 12.5%. So once you've seen a headline or a notice on maybe on Citizen TV or the local dailies, the first step is for you to go to CBK, that's the Central Bank of Kenya, to open a CDS account with them. So for you to do that, of course, you need to fill a couple of KYC requirements.
Yeah.
So they'll give you what we call a mandate card.
Yeah.
And for that, you need your passport size photograph, your ID, national ID original, or your passport, and you'll need to have a bank account with a local bank. So once they give you that card, you fill the details, you take to your bank account to stamp that they actually know you, you bring back these documents to the government, and within a week or two, the CDS account is open.
Is ready.
Yeah.
And you can then begin trading.
And you can begin trading.
Okay, so take us through then how this works. Let's assume now we're knowledgeable with this lingo. There's a paper that's been floated, maybe it's 10 or 15 years. You have the 100,000, you have your CDS, the Central Depository System account. Then what? So you buy the bond, and then what happens in the course of the 10-year period?
So normally what you do once you've already opened the CDS account, so you have an account under Yvonne, you've seen a paper that you want to buy, you can purchase it directly with the central bank. So you can just place a bid, and there are two kinds of bids. Maybe we can start with what's a bid.
Yeah.
So a bid is an intention to buy. So you're telling the government, I have 100,000 shillings that I intend to lend to you. In return, you're going to give me an IOU, which is sort of just a document. And today we are digital,
yeah.
So it's just keying it into your CDS account, which is digital. And you'll say, I need to buy competitive or non-competitive. So it depends on the amounts you're investing. Anything below 20 million, you bid non-competitive.
Okay.
Any amounts above 20 million Kenya shillings, you have to quote a rate. And that's a rate at which you're willing to lend the government your money at.
Okay, so you can quote the rate if you have 20 million or above.
Correct.
I guess because it's a lot of money.
Because it's a lot of money.
Okay.
So once you do that, then now there's an auction period, which is the period which the government is selling that paper. So considering maybe you invested your 100K, like the local Mwananchi,
yeah.
The auction period is maybe 4 to 5 days. Once it closes, of course, you bid non-competitive since it's below 20 million Kenya shillings. And so the government will come and say, okay, we needed 10 billion. We've received bids for 12 billion. Out of that, of course, you're going first to pick the non-competitive, which are the guys who are okay accepting our rate. And for whatever deficit, we can then quote an average rate that we're going to give these other people. So anyone at that rate or below gets the paper, anyone above is cut off and has to try next time.
Okay.
Yeah.
Okay. So then now you've bought the bond. So what happens? I know you talked about the coupon rate or the interest rate. So let's work with a figure of 100,000 shillings that you put in, and it's for a 10-year paper. So what happens? You are receiving, explain to us how you receive this coupon rate. Is it for the entire 10-year period? So
two things come into play. If you're buying this paper for a long time and you will be in that paper for 10 years, then it means essentially every year, assuming you bought it in a Ethiopian world, you bought it in January. So in June, and the rate, again, let's work with 10%.
Yeah.
So 10% of 100,000 shillings is 10,000 shillings, which again, I'd mentioned is paid semi-annually. That is twice a year. So you bought this paper in January. In June, they're going to give you 5,000 shillings. I beg your pardon. In December, they're going to give you another 5,000 shillings. That's the end of the first year. If you're going to hold this paper to maturity, which means till the end of that term, which is 10 years, then you're going to be receiving these payments twice a year for the duration of that period, which is 10 years. At maturity, which is at the end of the 10 years again, the government is going to give you back your 100,000 and the interest at that particular time.
Of that year.
Of that year.
Okay.
So that's the first scenario. Second scenario is you bought a 10-year paper. For whatever reason, you need your money back. You found a better alternative investment, or it just, for whatever reason, you need to quit that investment. You come to a secondary intermediary, which is, again, an example, Genghis Capital, and say, I want to sell this paper. So you'll be receiving coupons, say you've held that paper for 3 years. For those 3 years, it's just like our early example, you'll be receiving your coupons for those 3 years. Then at that third year, when you come to Kevin and say, I want to sell this paper, I'm going to find a rate in the market. I'm going to find a buyer. Once I find a buyer, I seal that deal. The buyer, so if I'm selling to you, Yvonne, you'll pay me my money, which is 100,000, and now that bond will be registered under Yvonne.
Okay.
And you'll continue receiving the payments going forward, and I'll cease receiving those payments.
I see.
Yep.
Okay. So one would then receive now for the 7 years that is left of that
correct.
bond. Just a question. You can't sell this bond back to CBK. You have to do it in the secondary market?
No, you can, but it's the last resort. So it's the worst possible outcome for you.
Okay.
The reason you're going to the CBK means you didn't find any buyers in the secondary market. So it's one of those papers, maybe it's had the pathetic rate or the economy was spiraling down, you know.
Yeah.
So once you've tried looking for a buyer in the secondary market and you can't find any, the CBK works as a bookmaker. So they can buy that paper, but they're going to penalize you almost 3 to 6% just to take that back.
Okay.
So it's always advisable just to wait it out to the secondary intermediary until you find a buyer.
Okay.
Yep.
You know, so there's a lot of people who think, wow, 10 years is a long time. So how does this differ? You know, I mean, obviously, bonds are a long game.
Correct.
And that's not to say that you can't get out. Like you told us, you can do that at any point in time.
Correct.
But is that a way in which, you know, bonds differ from shares? Even from your SACCO, for instance, or you know, getting a bank loan. Could you just give us some sort of comparative analysis of bonds versus other investment options that are available in the market?
So I think I've mentioned these before. I'm sorry to use this example again. I have a friend of mine who is called Calebent, is always asking me, I have 1 million shillings in the bank is giving me 6%, I can access this cash anytime I need to. You know, my circles are paying me dividends at 10, 12% per year. You know, your Safaricom or your Royal Media, if it's listed at 10 shillings, now it's at 20. Why then on earth do I need to go to buy a bond? But there are subtle differences and those that are really clear. So one is the government or a government bond is the safest kind of investment. What I mean by that is the only risk to a government bond is, of course, default. And for a government to default, it means the economy is on its knees. When the government is getting to that particular
Some would say the
point,
government is on its knees right now.
It is, but remember they can always print money, yeah? So we're still surviving. So for the government to really, go the way of Somalia or Sudan, we have a coup, we have such kind of extreme events, exogenous events, Your Safaricom, your Real Media, all these other companies will have collapsed. Your SACCOs, your banks, all of them will have collapsed. So I always say government bonds are the safest kind of investments. Because remember, for the government to pay you, even if they don't have money, this is local debt. You're buying in Kenya shillings. They just need to print the money and pay you back. Or increase taxes.
In the worst case.
Yeah, in the worst case
money.
scenario, But then again, I keep telling people, you take, my friend Caleb, you take your money to the bank, Equity or KCB, for instance, they take your money. They want to put. I keep telling people, they don't put money in a safe somewhere until you come and withdraw it.
Exactly.
So they
what do they do with the money?
They take the money and
and
loan
buy government bonds?
They loan it to Yvonne, or buy government bonds at 12%, pay you 6%, pocket the difference, which is 6%. So essentially, you're empowering your local bank to use your money to invest on your behalf, but pay you half of what they're going to earn from it. And remember, your bank again can go down any minute. We've seen that with Dubai, we've seen that with Imperial, we've seen that with the Chase Bank, and so on and so forth.
Right.
So government bonds for that risk-averse investor or someone who really likes minimal risk is the safest way to go. Above shares, above your SACCO dividends, above your deposits with the bank. So it's the safest kind of investment. And that's the main difference that government bonds are preferred. So, you know, Yvonne, you have your sister whom she's young, she needs to go to university in 10 years or 15 years. You have this money you need to keep aside, you need it to grow, of course, but you need to protect the principal, which is that amount. So the safest way to invest this money is just buy a 15-year government paper. You'll be receiving the coupons at the end of the 15 years. They're going to give you back your 10 million to take your sister to school, and you've protected it. You can't say the same with banks. For instance, those who've been in Chase Bank, you can't say the same with SACCOs. We've seen SACCOs going down. You can't put the money under your mattress. You can be mugged, you know. So government, again, is the safest way of investment. The other difference on how they operate is shares, you earn dividends or capital appreciation. So you buy a Real Media share today, it's at 10 shillings. At the end of 6 months, you want to sell it. Maybe it's at 16 shillings, so you have 6 shillings appreciation. But that's not guaranteed. Or Real Media performed really extremely well, and they decided, okay, we're going to give 2 shillings dividend, which is sort of like an interest for buying our share, giving us your money to operate. And so you add your 6 shillings, they paid an interim dividend or final dividend of 2 shillings, that's 8 shillings, and you find whatever percentage you've been paid. So government doesn't work that way. Government is to give them your money every 6 months guaranteed, regardless of the economy is doing well or bad, they have to pay your bond. Whilst instance, Royal Media Services or any other company, the dividends are discretionary. So they decide when to pay you or when not to pay you.
Absolutely.
Yep.
And, just already getting some interesting feedback on this. I think Eston E. Quach says this is a very good show, good information. I like the way the information is simplified. Thank you. Evans KE says, such a good class. Thank you. By the way, just a reminder, can we have the bell today again? Would be good to, just remind everybody that class is in session. We've had a few of these. So I'm seeing definitely some more questions coming in, and we'll get to those in a moment. I want to just try and finish as much as the questions I have and leave as much time as we can for our viewers. So please do make sure that you can send us in your feedback at Citizen TV Kenya, at Yvonne Okwara. Please use the hashtag #BusinessNow. That's how I'll be able to track some of your questions, and we can have them up on screen and have them answered here, on the show. So like we said, the interest rate is fixed, right? It doesn't. Does it fluctuate during the course of the bond?
Most of it is fixed.
So it's predictable, you would say.
You'll know what you get.
Yeah, and one of the things when you were talking about safety, or rather, the risk of a bond versus the others, government does pay its debts first before it pays anything else, including salaries, right?
Correct.
Yeah, so we can then hold this government to account the way China holds us to account. Right?
Correct. We can do that.
We can come in and say, hey, you owe me money and that sort of thing, and how it works. What else can you do with a government bond or the paper? Is it something that you can use as collateral, say, for a loan?
Smart enough. Correct, you can do that. So we have this CDSC, which is sort of like a regional registrar. So you can take you invested your 2 million paper in a government say a 5-year paper, you can go and you need some money maybe for your construction or your kids' school fees or whatever. So you can take your paper and go to your registrar and have it stamped as lien, So they're holding that paper, and a local bank can then now give you 1 million or 2 million shillings, close to the value of that paper, as a loan. Okay. So you can use that as a collateral, the same way you use your title deed, the same way you use your logbook, the same way you use any other asset you have. So to answer your question, yes, you can do that.
And what about tax relief? Is there any tax relief that's offered on this?
Which brings me to an earlier point that I think we skipped. So there are two, again, kinds of government bonds. So we have IFBs, which is an infrastructure bond. So essentially, IFBs were, again, from the name infrastructure, is government raising money to, say, build the SGR or build the expressway or build whatever road, So they would issue that, they would say, okay, we need 10 billion to build Likoni Road or whatever, and you're going to give 12%. So we are not going to charge interest on this, since you're giving us money to put up an infrastructure that is for the good of the people. So those ones are essentially tax-free. Then we have the fixed coupon bonds. Okay. Those ones attract a tax of 10 to 15%, depending on the amount you're investing. So anything, I think, above, anything below 10 million, I think, attracts 15%. Any amounts above 10 million attracts 10%. Okay. So those are the two kinds of investments. In terms of tax exemptions, I think now those ones, like those that fall under the Ministry of Gender, if you're a disabled person and you have that registration number, and that you can then take it to CBK, and you can be exempted for tax. So we have those subtleties as well. Okay,
and it's important to remember the taxes. So tell us, like you said, it's something we can go directly to the central bank, put in our bid and say, I have X amount of money, 100,000, and then maybe, 50,000 and above. But can this be done through any other organization, or is it me walking to central bank and saying,
Two ways. You can do it by yourself, like you mentioned, just walk to Central Bank of Kenya. Some people fear going to Central Bank because they go out to then the military and
I know it can be a little intimidating going to the central bank.
So we have an easier route for that. So you can go to a market intermediary, and those are investment banks and stock brokerage houses, for instance, Genghis Capital. So the initial step, you have to do it by yourself. So you have to go to CBK and open that account so that they can verify this is Yvonne, this is her ID, PIN, whatever. So do the KYC, know your client. Once that is done, you don't need to go to CBK ever again. You can, even at the comfort of your house, you can invest digitally nowadays, or you can just go to your broker, because some people need to know, okay, where are the yield curve, where is the yield curve, what are the rates that the government has been issuing. If they're issuing a 7-year paper, how does this 7-year paper compare to other 7-year papers in the market? Is this a better investment, or should I opt for another one? So that's where the market intermediary really becomes crucial. And
market advice,
Market advice, correct. So, or financial advice. So they'll come to us and say, we've seen this paper, what do you think? Should I buy the 7-year paper. And I can tell you, no, actually, this 7-year paper doesn't look as lucrative as a 7-year paper that we had already. So you find government had issued a 10-year paper. Right now, when you're talking, it's a 7-year paper. So I'd advise you to buy this 7-year paper as opposed to buying this newly issued 7-year paper. Yeah.
Where is the information on this paper when they put out the request for bids? Where on earth do I get information about, what the government is offering?
So when you can get it, they always put it in 2 local dailies. They'll always run it by your media houses. If you go to a market intermediary, they'll always, or you can even just log into your CBK account and you can look at the auction offers. You can go to a market intermediary or call them or email them and mostly just send it out even without you asking. Okay. So the information has been democratized. It's everywhere.
Okay.
Yeah.
Okay. So there is that. And I wanted to, understand about information. What do you say to persons like Dr. Goa Moja, who says government bonds are the safest, but unfortunately, too long for profit?
It depends on what kind
people want their money now.
People want their money now.
But investment doesn't quite work that way.
I don't know what exactly he means by it takes too long to earn something. Because if you're buying a share, for instance, you don't buy a share today and sell it next week unless something extremely crucial happens. So normally, investments are normally long-term. Those are the kind of safe investments are long-term. So even when you buy your shares, if you can remember the Safaricom IPO, people bought it at 5 shillings. It went all the way to 2.5 shillings, and people were out there pissed and rushing to sell. People were taking loans. They're like, what? And people didn't understand how. Remember, this is when our capital markets was really taking off. So right now, as we're speaking, Safaricom is around 37 shillings. You can imagine if you held it all through since 2007, or is it 9? So that's how always when you're getting into investment, always work with a long-term view. Your front view should always be long-term. But again, things happen in between. So government, again, bonds, they'll pay you every 6 months. So I think they're better when you compare them to shares, because shares will declare results, half-year results, probably declare dividend or not, depending on their dividend policy. But government bonds, whether we are on our knees or not, will always pay a dividend every 6 months.
Which, and I know you've touched on that, and we can talk about that just a little bit more before we go into the break. What's the sort of mindset one should go into, when doing an investment, government bonds or indeed, any others? Of course, we understand that investing in the saving culture is important for the future, but I think sometimes also there's a struggle to sort of make it and survive today, tomorrow, next month. But what's the general mindset that we should have even before we say, okay, we're going to open the CDS account and we're going to start, which by the way is the same one for shares, correct?
Correct.
So what's that mindset we should have before we even start considering government bonds or any other type of investment?
So the fact that you've already started thinking about it, that's the first step. That you've sat down, you've looked at your income, whether you're employed or in business, and you've decided, of course, I need to put aside some money for a rainy day. You don't put that under your mattress. I'll advise everyone, don't put that money in your bank. Find something that, as much as you're putting that capital away, which is something called capital preservation. So that looks at safety of this capital, and that's something that I really discourage people. SACCOs are not a bad investment, but really look at the SACCO you're investing in and what exactly the SACCOs are investing in. Because if it's a SACCO, you've seen this story in SACCOs where I'm a member of a SACCO. I've been with the SACCO for say 2 years. I have 1 million shillings in deposits. They can give me 4 million shillings in a loan.
3 times.
All I need 3-4 times in a loan. All I need is Yvonne to come and sign that they've guaranteed me. And you'll find people being brought documents and they're just saying, Yvonne is my friend, I'll just sign. Then I go there and default. And now the SACCO starts chasing you, you have nothing to pay them, and they have to count it as a bad debt. And that's how increasingly SACCOs start falling. And we've seen that in the news over the last few years. So the first step that you've decided, okay, I'm going to put this capital, look at the safest way to put this capital. Give it back to where it came from. It's like giving back to Caesar what belongs to Caesar. Give it back to the government. So once you give it back to the government, remember they'll always be paying you these, let's work with that 10% dividend. So you look and you decide, and I've seen guys also who are like, why shouldn't I buy land? I bought land in Kamulu. In 2 years, I bought it for 100K. Now it's 300K. But we as a frontier market, or as a third world market, for lack of a better word, our markets are quite dynamic here. So yes, you bought this land 3 years ago. Now it's appreciated 400%. But what's the guarantee? There's something called the bubble. There are certain reasons why your investment has been going up, and the same could reverse and it could go down to nothing. Also, the other thing I see people saying is, I want to put up rentals. I can be making 10,000 shillings in rents. I have 10 houses. That's 100K. But you need to look at, you've seen what has happened, exogenous factors like the pandemic. We have the Ukraine invasion of Russia. All this has led to job losses. Companies are shutting down, manufacturing less. Government is in need because it can't raise enough taxes to sustain us. So the question you need to ask yourself is, in a period like the last 2 years and now almost 3, how would you be getting your rent? Probably you don't have any tenants. But with the government, remember, it's always a 10% guaranteed.
Right.
Yeah, and
For
that can never default. Yes. So safety is really key when you're looking at it. And the good thing is, again, this is not money you'll go to an ATM on a Friday and decide, okay, I have 100K, I can just withdraw 10,000 shillings and go to Dunda with our friends. Yeah. So it's you sort of have some respect to it. It's not quite as easy to access it.
Yeah. And I think, like you say, that's the mindset. Look, if you're trying to put money aside for a rainy day, then you can't keep going back into that kitty and dipping into it.
Correct.
I mean, of course, life happens, and there are some situations where you do need to.
Correct.
And that's the beauty of it, is that you're not fixed for the 10 years.
Correct.
You can get out, when you need to. But it absolutely has to be very important for you, and that you have no other source of right, you're against the wall. So look, we've got so many more questions that are coming in. We will get to them in a moment. Thank you for staying with us. We're due for our short break here on Business Now. Kevin Giga is still here with me. Much more. Look, lovely questions. Lanya Maxwell, James Zemu, Anthony, I'm seeing many of your texts and your questions. We are coming to those when we return from this break. Business Now, classes in session. Investing in government bonds. We'll be right back.
So nice one. Where are they ringing it from?
And class is back in session this afternoon on Business Now, talking about investing in government bonds, how that compares with other forms of investment, for instance, buying shares or investing money in your SACCO or putting it in a fixed deposit in a bank or buying a piece of land. So we've already gotten into quite a bit of that. I want to get into your questions now, but just a few that I want to ask very quickly. One of them, Kevin, is that you can buy more than one bond.
Correct.
Yes? Okay, so I can buy one in January, one in February.
All the way to December.
Okay.
Yeah.
All right. That I wanted to get out of the way. I mean, I think the other thing I wanted to ask is, for many people, they're saying, but 100,000 is a lot of money for the common Mwananchi. But there was a bond like, was it Emma Kiba?
Correct.
So tell us about that. The government is trying to make efforts to democratize this so that, people who have less than 100,000 can actually invest in government bonds. Yeah,
so what the idea behind it was quite noble. So you'd find that bond markets are predominantly or primarily filled with top banks. So your KCB, your equity, and it's sort of like a collision, sort of forms a cartel. So when the government says we need 5-year money, or we're issuing a 5-year paper 10%, and they're like, okay, we're looking at the economy, and this government really needs to pay more for this money because we can get better elsewhere. So they decide, okay, we are going to sit out on this paper, we're not going to invest in it, and the government is trying to raise, say, 30 billion, and they can't raise even 10 billion because the big players could not participate. And your local Mwananchi, which is like 100,000, has money, but they don't have enough watches like the banks.
Right.
So the government thought through it and decided, okay, what you're going to do is you're going to increase the number of players that can loan us money. Yeah. So you can take your 3K, you can take your 5K, you can take all these small amounts, and eventually you find that we've raised 30 billion shillings. Yeah. While at it, we are trying to, of course, democratize this bond investment, making people aware of this investment. We're inculcating a saving culture with the citizens, which is a really good culture if you look at a country like China. So that was the idea, the noble idea behind Emma Kiba. But then other external factors, exogenous factors affected it.
Okay. But yes, at least that there is that window occasionally to look out for, that comes from government. But they floated it a second time.
They did? And they're planning to do it at that time, but we're still waiting for that.
We're still waiting. Yeah. So, and that one was being done on your phone,
digitally,
right?
yes.
Yeah, it was really simple to get it ddone, and you would have and people were allowed to put in a bid of 3,000 shillings, right?
Correct.
Or multiples of that thereafter. Right. So it's not just about, 100,000 shillings for many who say, look, that's out of the way for many of us. Okay, so let's get into a few of the questions that are coming in here for you, Kevin. Okay. So there is from, again, Dr. Goa Moja says, when buying bonds, must you quote the source of your income, like how banks require when you bring in more than 1 million shillings?
So normally when you come to a market intermediary, your funds will already be sitting most probably with a bank account, with a local bank. So the local bank will have already cleared that KYC. So if you have your 1 million shillings or 10 million shillings, know your client. Yeah, okay. Know your customer, know your client.
Yeah.
So the bank will have already cleared that for the market intermediary, say Genghis. So once you come to us, we don't need again to start knowing the sources of your capital. You can see your funds are sitting with Equity Bank, for instance. They've already done your know your client briefing. So for us, it's just to invest. But if you're going to bring in 10 million shillings to us in cash, then we have to indicate the source of that.
Yeah, because, I mean, look, buying government bonds could be a very, big source for money laundering.
Correct.
So it's true to say that all of the rules that apply, when you're taking money to your bank, also apply when you are going into government
Correct. Prudential
bonds.
guidelines, they apply to all and so on.
Okay, all right. Anthony says, good show. What is the procedure of acquiring infrastructure bonds in the secondary market, and do they pay biannually as well?
I'll start with the second bit of that question. Yes, all government bonds pay biannually. So the infrastructure bonds, which are the tax-free bonds, or the fixed coupon bonds, which are the taxable bonds. So those are the two main kinds of bonds that are issued by the government, and both pay semi-annually.
Yeah.
And yes, you can buy infrastructure bond, as with the fixed coupon bond. You can either buy from the issuer, which is the primary market, or you can buy from the secondary market, which is the market intermediary. Just come to us and tell us, I need an IFB, which is the infrastructure bond, for this amount. This is what I'm willing to pay. Please show me what's available, and that can be done.
All right.
Yeah.
So you can buy off the secondary market and from the CBK, which is the primary market.
Correct.
And all of them will still pay biannually.
Correct.
Jose says, if I already have a CDS account that I'm using to buy shares at the Nairobi Securities Exchange, can it still be used for bidding bonds?
No. So we have two kinds of CDS accounts. So we have a bond CDS account, which is one you open by with the central bank, CBK, and we have a shares account, which is the ones you buy your normal Safaricom shares, equity, and all that stuff, which you open with a market intermediary who is the liaison between you and the Nairobi Securities Exchange. Yeah, so CDS accounts are into, essentially, if you need to invest in both shares and bonds, you need the two different CDS accounts. Yeah.
Okay. So at least that's answered. So there are two different ones. Okay. Major John says, he has two questions. Okay. If someone purchases a bond that lasts for 10 years, for instance, as the interest accumulates over the years, is one allowed to withdraw the interest, and is the interest compounded?
So once you've bought a 10-year paper, remember one of the requirements we mentioned for opening a CDS account with the CBK is you need to have a local bank account. The reason for that local bank account is when the interest is being paid semi-annually, you don't need to go and queue outside the CBK towers. Yeah. So automatically it's credited to your bank account. So if you invested 100,000 shillings, every 6 months, the 5,000 shillings will be put to your local bank account. In June. In December, they'll put the 6,000 shillings, and it will go on and so forth until the maturity of your 10 years. Then they'll give you back your 100,000 shillings and the 10% discount. Okay. So there's no compounding since the money is paid to you already.
All right. Yeah. And you, once it's in your bank account, obviously
you can withdraw it. Yeah, you can withdraw it.
Or you could choose to maybe keep it there until it accumulates, and you can add on.
Yeah, and remember we mentioned T-bill, you don't need 100,000, you need 50,000 shillings. So you can decide to keep it there, and once it gets to 50K, you can decide now, you know what, I'll buy a 1-year paper. And with the 1-year paper, the beauty of it is you can keep revolving that cash for as long as you want. Or
you could add on to that bond of 100,000,
or you could add on to that,
And that happens now in multiples, like you said, of 50,000.
50K, correct.
Okay. All right. Munyao Simon says, a good deal, exactly how I wish I knew this 10 years ago. This way, Mr. Kevin, you're doing good by educating us, since now I know one can buy and secure a 10 years plus deal for future use, unlike, other institutions. Yeah. Irene Kiruri says, can one make a one-off investment of, say, 100,000, or must one top up?
You can make
buy that one bond
and sit out,
Okay.
Yeah.
Okay. All right. Or you could buy more.
Or you could buy more
if you're blessed with more money.
Correct.
Hey, okay.
Like you.
Amen. From your lips to God's ears. Thank you. There's a time government was selling bonds as low as 4,000 and one would purchase via M-Pesa. Is it the same thing? Victor Peter asks.
That's the Makiba we just talked about. Okay. Yeah. So right now we don't have that, unfortunately. We're waiting for it from the government.
Okay. Yeah. All right. Nelson, I'll come to your question because you're asking about T-bills, so maybe we can answer it now. Nelson Basweti is taking us a little bit off topic, but we will answer the question no less. You say, please shed some light on T-bills. How often do they give returns? and what is the average interest rate?
So T-bills, again, just as a quick reminder for anyone who probably might have missed, like Moses, or was that his name?
Nelson.
Nelson.
Like what we said at the beginning of the show.
Yeah, so
right.
T-bills are any government, it's the money you give to the government that is less than 1 year. So we have 3 kinds. We have a 3 months, which we call the 91 day. We have 182 days, which is 6 months. And we have 364 days, which is 1 year. So those are the 3 kinds of treasury bills that we have. Remember, any investment, 1 year going down. So T-bills are auctioned every week. That's the beauty of it. If you miss it this week, I think it's on Thursday. If you miss it this Thursday, you can get on to next Thursday, and so on and so forth. They're always looking for around 10 billion shillings. The government is always looking for around 10 billion shillings. So you can always get onto that. Yeah. So the 91 day or the 3 months right now attracts around 7.13%. Remember, this is an annualized rate. So if it's 3 months, remember you have to divide that rate by 4. Yeah. Then we have 6 months, which is the 182 days, which is around 8, I think, 0.2 or 0.3. Again, that's an annualized rate, so you have to divide by 2. And we have the 1 year, which is, I think, around, 9 or 9.1%. That you don't need to divide by anything. That's 9%. So if you had your 100,000 shillings, you bought a 1 year T-bill at, say, even 9%, you get your 9,000 before tax.
Okay.
Yeah.
Oh, okay, before tax. And then, and I think that's important to understand. Typically, between T-bills and T-bonds, which ones have
better returns?
Better rates?
Bonds definitely have better rates because of the duration of the paper. So you're giving your, if I'm lending you 1,000 for a week and I'm lending David 1,000 for a year, David has to really pay up because he'll have my money longer.
Yeah.
The risk of default is definitely longer with David as opposed to you.
Right.
So the government, of course, remember, it's unlikely, but the government can still collapse.
Yeah.
So the government will pay you longer for having your money, will pay you more for having your money longer. Yeah.
Okay. Junior Wamaitha, I think we've answered your question. You said, what if I want the dividends to be invested back into the account? Yes, the interest, like we said, is put into your bank account. You can decide to withdraw it, do what you want with it, or you could decide to keep it until it gathers up to 50,000 and come reinvest it, back in the bond market. Joseph from Beva says, good and in-depth analysis of investments, especially on government bonds, learning new investment tricks every day. Thank you. That's what the show is all about. Karibu sana. Then here is another one. Fred Tunya. You may have answered this, but just let's go through this one more time. Fred Tunya is asking for a clarification. If you invest 200,000 in a 5-year government paper, depending on the interest rate, for instance, 10%, do you get your 200,000 plus 10% annually, or twice a year, or you only get the interest during that period? I know you said this, but let's just go through this one more time for Fred's sake.
He's trying to be lucky. We could all be doing that.
There is no way you can do that. Like, you put in the money and you get it back. And
every 6 months, there's no free lunch. So you put in your 200,000 for a 5-year paper at 10%. That means you're getting 20,000 in interest per annum. Okay. Government pays twice a year just to reduce its debt burden. So 20,000 per annum means they're going to give you 10,000 shillings in June or wherever your 6 months will be lapsing at. Most likely it's usually in June, and 10,000 shillings in December. So they'll give you 10 for the duration of the bond, which is the 5 years. Then after 5 years, they'll give you back your 200,000 and your 10%. That's how it works. So you only get your principal, which is the money invested at maturity at the end.
Okay. Yeah. And I think that also answers another question here about the money and what happens to it. So you get your initial investment at maturity. Correct. Right? But in the meantime, you continue to earn
coupons or interest.
Yes, coupons or interest rate. Yeah. So this is some really interesting stuff. We also had, I think, a question on the difference between the money market and government bonds. Yep. And maybe you can explain what the money market is.
So government bonds, I think we're pretty clear right now. Yeah. So money market funds, basically just people call money market or MM, is you take your 100,000 or 200,000 like Nelson, take your 200,000 and you decide to buy a money market investment. So most money market investments are issued by local banks or investment banks. So you come to us and basically is Nelson giving us his 200,000 shillings. And what we do with that 200,000 shillings is just, we have a team of who we call experts. We sit down and decide where can we best invest these 200,000 shillings to get maximum returns. Yeah. And so we'll get these 2,000 shillings. Money market are generally safer than equity markets, equity funds, because they invest primarily on government bonds and a bit of it on corporate bonds. We've seen a couple of money market funds suffering because they invested in some corporate in some corporates that end up defaulting or going under. We saw that with Chase Bank and etc. So Yes, essentially, and I keep advising people is money market funds are good if you're the busy Vaughn, you don't have time to look at the markets, you're quite on the road, but you need nevertheless to put some money to invest. So if you're not the person to follow up with your market intermediary like Genghis Capital every now and then, you don't have time to look at what's happening to the economy, you're not an economist, you don't know the numbers, then you can just go to your top local investment bank and just buy a money market, because they're going to do what you should have done by yourself. Yeah, but if you ask me, I think the easiest and safest way to go if you want to learn about these things is just doing it by yourself. Okay,
okay. And indeed, Munene, who's just sent a text, says, and it's a reminder, once you register at the CBK, they then send you SMS info on upcoming bonds,
correct,
the tenure, the rate, the tax, as well as the results of every auction.
Correct.
So once you get in that, and I think you receive the message, like you said, for the T-bills, the auction is every Thursday.
Yes.
So I think you receive those messages then as well. Yeah, I was checking it. The message reads like this: Dear investor, T-bond, FXD1 means what?
It's a fixed coupon bond.
Okay, fixed coupon bond.
So one is the first. Go on.
The first bond, 2022, 2023.
That's the year.
Okay.
Yeah.
And fixed bond, 2022 / 15.
That 15 is the duration, so 15 years.
So it would be, okay.
It's a 15-year paper issued in 2022.
I see, got it. Dated 11th of April and 25th of, so they're giving two different ones.
Correct.
One is a 3-year bond, one is a 15-year bond.
Correct.
And they say respectively on sale, go to, and they give the website for full information. Then there's another one, Dear Investor, auction results for Treasury bills 91, 182, and 364 days, value dated on the 28th of March have been released. Go to this website for more details. So that information continues to come to you once you register with the CBK.
Correct.
Okay, that's important to go through. All right. So one of the things I think Jay Sabakaki or Msema Kweli on Twitter says, I took a 30-year bond. Government has since repaid me all the money in full by way of interest, yet they are still paying me every 6 months. And in the end, they'll refund my son the money. Interest rate was 13.9%. There was no withholding tax. Not bad at all.
Yep.
Right?
We have such bonds, yes.
Yeah.
So you can really make money from the bonds if you sit out. Remember, we said you have to start with a long-term play. There are a couple who you find you bought a 25-year or whatever, a 20-year bond, and you find that at 13 years or 4 years, you find you almost fully repaid your money. But still the government will continue paying back your money. And at maturity, at the end of that contract agreement, is they're going to give you back your whatever amount plus the interest.
Right.
Which brings us to a question I think you might have touched on earlier on amortization.
Yes.
And people might see, what's amortization and stuff. So a government will come and say we're issuing 10-year, we're issuing a 10-year paper at auction. For this 10-year paper, we're going to amortize 50% at the 6th or 5th year. So what the government is essentially doing is trying to reduce its debt burden after the 10 years where they have to pay everyone, say, 50 billion.
Okay.
So they'll decide, okay, we're going to settle some of this principal, which is 50% after the 5 years, and then for the duration of the 5 years, we are now going to be paying you on the remaining 50%. So it's just a way of government reducing its debt obligations.
Okay.
Yeah.
JMO Elvis says, interesting topic. Now that I've opened a CDS account and decide to do trading via a broker, how do you choose the right broker? I know we've discussed this with you on the show, Kevin. What decision goes into which broker? So
first, how to know which broker to use is you can go to the Nairobi Securities Exchange website and it will show you a market of market participants. Yeah, and we are around 20 or so. How to choose a good one is, you have to look at various things. You have to look at rates they're giving you. You have to look at customer service. How is it to access these people? They always have to wake up Monday morning and go to their office because we are living in a market where things have been digitized. Yeah? If your fridge can text you and tell you we have shortage of milk, I don't see why Yvonne you should wake up Monday morning, come to Westlands, Prudential Towers to Genghis Capital and say you want to buy a T-bill. That's information we should be able to just do from your app. And we have all these sorts of savvy apps that you can use at the comfort of your couch. Yeah, we have, for instance, at Genghis, we have Jacuzzi where you just go to it and you can decide to buy a T-bill, you can decide to buy shares, you can check your account, you can be credited digitally, you can debit digitally, you can do all those sort of things. So go to a market participant who best understands your needs. If you're a busy person, you don't need to to be their office. They have a customer service desk that you can call and they can pick on the first or second attempt. If there's an issue, they can call you. If they have, they are sending you information on what has been issued. They're just giving you basic information. That's how you choose a good one.
Okay, and market advice. And always to make sure, first of all, they're usually registered.
Correct.
That's the thing. And like you said, they're on the CBK website. So it's important for you to...
website.
Sorry, the NSC website.
Correct.
So it's important to make sure that you are actually with one that is duly registered and licensed for the same. How many minutes do I have? 5. One last question, Kevin. What are unit trusts and how do they work? From Hilary Basilai.
So unit trusts are essentially, remember when you mentioned a money market fund, so that's an example of a unit trust, yeah? So unit trust is a pooled, it's where a company, say like Genghis will come and say, you want to invest in a bond, you only have 3,000 shillings, the minimum is 100, or T-bill, the minimum is 50. So what do? We still need to find a way for you to invest and you need a bond. So we'll bring you Yvonne, we'll bring Wahiga, we'll bring a couple of other people, pull your funds together, put it together, and now we have 1 million shillings. So you can go in, buy a 1-year paper or a 1-year T-bill at 10%, and then now we can pay you dependent on how much you invested in it. So that's essentially how a unit trust works. It's just a pooled source of funds that is invested together as one, and you're paid dependent on your investment and how long you stay in it.
Okay, all right. Thanks for answering that. Wahiga, you heard we should get into a unit trust together. So thank you very much, Kevin, for coming through. It's always such a pleasure having you on the show. I suspect we might need to have you on again because there's still so many more questions that we couldn't get through. Please give us your final words on this. Why this is important, why investment is something that we all need to think about, and why we need to play the long game.
So we've seen what the last 2 years have been, or 3 years, with what I call the exogenous factors. No one could predict we'd have a pandemic, no one could predict Russia would get into Ukraine this early, and we've seen how people have been laid off, including from government and big institutions. Businesses have gone down. We now have this shortage of fuel, and maybe some people may not go to work. So I always say, whatever you earn, and it doesn't matter, forget what you've heard us talking about, the 50,000, the 100K, whatever you earn, if it's 500, just put it together somewhere you cannot access it. Before you know it, it will be 3,000. And you can go to a market intermediary and invest in a unit trust, like I mentioned. So always have a fund for a rainy day. And don't be like my friend Caleb. Don't put your money in the bank. Just take your money and do something with it where it's protected. Again, government is the safest, or the top institutions when if you want to buy shares. And just earn your dividends and learn to survive where you cannot touch that money. Learn to live
within your means now. Yeah, absolutely. Because, banks take your money and buy government bonds.
Correct.
Why not buy government bonds
directly?
Yourself? Yeah, all right. Kevin, it's always a pleasure having you. Ladies and gentlemen, Kevin Gige, he's an equities trader at Genghis Capital. And he's always very, very informative with these shows. We'll continue to have more classes of the